Are trend lines just magic lines on a chart? Well, let's get one thing straight right off the bat. Most traders treat them like they are. They draw a slanted line across their screen, cross their fingers, and just kind of hope the market magically respects it. But listen, if you're treating trend lines like some crystal ball that predicts the future, you're setting yourself up to fail. Today, we're stripping away the myths and getting into what a trend line actually is. Think of this as an exclusive masterclass on the hidden structural math and institutional behavior that really governs the markets. Welcome to Trendline Trading Mastery. Today, I'm going to show you exactly how to trade with structural math and real institutional level precision. We're moving away from that chaotic retail guesswork that totally dominates the market and, let's be honest, usually drains your account. And we're stepping into a highly calculated, objective framework. I'm going to show you how to look at the market the exact same way the smart money does. Okay, so here's our exact blueprint for today. First, we'll hit the truth about trend lines. Second, the risk to reward edge. Third, why retail traders fail. Fourth, the power of Confluence. And finally, building your winning setup. Let's jump straight into part one, the truth about trend lines, where we're mapping market psychology. If you think a trend line is just a drawing tool, you're missing the entire game. Let's completely redefine what we're looking at here. A trend line is actually a dynamic visual map of market psychology, order flow, and institutional liquidity pools. Basically, these are resting areas where massive amounts of buy or sell orders are piled up. It's not predicting the future, it's just visualizing the path of least resistance. In an uptrend, buyers keep stepping in at higher lows. A trend line simply connects these points to create a visual structural floor. But here's where it gets fascinating. It actually becomes a self-fulfilling prophecy. Millions of traders see that exact same obvious line, and they place their orders right around it. Large institutions can't just buy millions of dollars of an asset all at once without violently spiking the price, right? So they use pullbacks to this structural line to patiently scale into their positions over days or even weeks. They're literally building a heavily defended fortress. Moving on to part two, the risk to reward edge. This is the structural math of trading. Now, before we get into the nitty-gritty of how to execute these trades, I need to show you the why. Think about the number 60%. This represents the massive asymmetrical risk-to-reward advantage you get with this system. When you trade a bounce off a validated trend line, your invalidation point, the exact level where you admit your thesis is wrong, is incredibly tight. You just place your stop a fraction below the trend line structure. But your profit target is often the previous swing high. Because your risk is so incredibly small compared to your potential reward, you can easily structure trades with 1-to-3, 1-to-4, or even 1-to-5 ratio. Do the math on that for a second. With a 1-to-5 ratio, you can be wrong 60% of the time and you will still be a highly profitable trader. You don't need a crystal ball. You just need to manage your structural risk. All right, part three, why retail traders fail and how you can avoid the trap. So you gotta wonder, if trend lines are so great, why isn't everyone rich? Let's talk about why so many retail traders completely lose their shirts and sometimes their sanity using this exact same tool. Notice the stark contrast between amateurs and professionals here. First, the retail trap. Amateurs desperately try to force lines to fit their own bias. They'll draw lines through random wicks, use incredibly weak timeframes like the 5-minute chart in a messy market, and blindly trade every single touch like a robot. Bottom line, bad trend lines equal bad signals. On the flip side, we have institutional mastery, the high probability, patient approach. We're looking for 3 or more meaningful touches. We want a clear slope that doesn't look forced, clearly visible on a higher time frame like the daily or the 4-hour chart. The reality is, the more obvious the trend line is to everyone, the more powerful it actually is. Which brings us to part 4, the power of Confluence, stacking the odds. Here's the thing, a trend line traded in absolute isolation is actually kind of weak. It's incredibly prone to false breakouts and traps. To turn a mediocre line into a highly profitable trade, we need our secret sauce, which is Confluence. We stack the odds by demanding multiple independent tools confirm the exact same price level. The absolute biggest factor here, our most powerful combination, is intersecting an angled trend line with historical horizontal support. When those two meet, they create a heavily defended hotspot that institutions aggressively protect. Then we layer on volume confirmation, major moving averages, momentum oscillators, and finally, price action candlesticks. When all of these things align, you've got an institutional grade setup. And volume. Volume acts as the ultimate lie detector for the market's true intentions right at the trendline. When price pulls back to our line, we want to see decreasing volume. Why? Because that shows selling exhaustion. The sellers are losing conviction. But the very moment it hits the line, we want to see a sudden, massive surge in buying volume. That tells us the big players have officially arrived to defend their liquidity pool. Now, if the trend line breaks down, it absolutely must happen on massive volume to be real. If you see price slip below the trend line on low volume, do not panic. It's highly likely to be a trap or a whipsaw, a fake move specifically designed to trigger retail stop losses right before the real trend resumes. Plus, we only do this in clean, trending markets, no choppy, news-driven ranges. And finally, multi-timeframe analysis. You find the line on the daily, wait for the pullback on the 4-hour, and execute your exact entry on the 1-hour. Final section, Part 5, Building Your Winning Setup. The execution framework. We've covered the psychology, the math, the traps, and the confluence. Now let's put it all together into a highly practical, step-by-step setup you can use today. Here's your bulletproof action plan. Step 1, zoom out. Identify a strong, undeniable uptrend on the daily chart. Step 2, draw a clean, unforced trend line connecting the higher lows. Step 3, now this is the hard part, patience. You wait for the price to pull back to the trend line, and you do nothing until you see confluence, horizontal support, the right volume signature, maybe an oversold RSI. And immediately, you place a tight stop loss just below that structural knot to fiercely protect your capital. If you take away absolutely nothing else from me today, please write this down. Never trade the first or second touch. The edge begins on the third. It takes 2 points to draw a line in the sand, but that line is completely unvalidated until the market comes back to it a third time and actually reacts. That third touch is where the institutional order flow finally kicks in. Having the patience for that third validated touch is exactly what separates gambling amateurs from calculated professionals. So I leave you with this final thought. Look at your charts right now. Look at your current open positions. Will your next trade be a random guess, driven by emotion, desperately forcing lines where they don't belong, or will it be a highly calculated, institutional-grade setup backed by structural math, extreme patience, and confluence? The path of least resistance is right there in front of you. It's time to leave the chaotic retail mindset behind forever. Stop predicting and start reacting to the structure.